Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm Michael Becker. It's our fifth episode here. It's starting to time starting to fly. I have my good friend Michael Ochstein in here. Mike, appreciate you coming into the podcast today.
Well, thanks for inviting me. I really appreciate it.
Yeah. So Mike is the president of Price Realty Corp, and you've been in Dallas for a long time. When did you first come to Dallas? You're from Indiana?
Indianapolis.
Yeah.
So I moved here right out of graduating from Indiana University, and I first learned about y'all. You hauled it out of the Midwest, and it seems like here we are. Fast forward today, everybody's hauling it back here from California and the East Coast, and so my first y'all was y'all.
When did you first move into Dallas?
So in August of '82.
82. And you started out of college. You were an investment sales broker for Marcus & Millichap.
Correct.
Is that right?
Correct.
So you've been buying, selling, owning, operating multifamily properties for 37 years, and now that we're kind of wrapping in almost 2021 here. So you've seen quite a bit of change and evolution through the last 37 years. So I think that's probably what we'll spend a lot of time today focusing on talking about. But maybe kind of go back to the beginning, talk a little bit about where you guys today. You're president of Price Realty Corp. Tell me a little bit about Price Realty. What do you guys focus on? What do you do for a day-to-day business here?
So Price Realty currently today, we have approximately 5,400 units under management, represents about $750 million of assets under management. We're in Houston, Austin, and DFW.
Yeah.
We have about 150 employees that works for us. We're vertically integrated, so we manage all our own properties. We even do our own K1s in-house.
Sounds terrible.
It does sound terrible. We have a great group of people. The person who runs my management company has been with me for over 25 years, and she took the brokerage out of me to really say what this stuff really costs to operate, et cetera. And she's been my partner in crime for like I said, over 25 years. So we've had a great staff, a lot of longevity. The regional managers, both in Austin, Houston, have been with us for a while, and especially the ones in DFW.
So I think a lot of people that are in this business, the market is completely different than what it's been, even 8-10 years ago when I first started buying my first deals, or 16 years ago when I first started loaning on multifamily properties. Everything's really evolved quite a bit. And you go back even further than what I did. So I thought it'd be kind of interesting to kind of hear firsthand from someone that lived through it, that participated in the market for 37 years, what's kind of evolved and changed. Because in my mind, as we were kind of talking about this, doing this episode, you really kind of had 5 very distinct markets and that you've participated in, where from the boom time of the early 80s to the bust of the RTC, to kind of the mid 90s, all the way to about the Great Recession in 2007, kind of slow plunging growth with the subprime stuff, to the Great Recession. And then, really the last 9 or so years have been kind of the golden age of apartment ownership. Has been unbelievable the entire time I've been owning real estate. So maybe kind of go back in time. You started at Marcus & Millichap in 1983. What was that like, being a broker in the kind of the early 80s in Dallas, Texas?
Mike, it was absolutely wild. I mean, I just got out of college, and I was a broker, Marcus & Millichap, kind of a trainee, working with some older, brokers, and and everybody was buying deals. Everybody was drinking Dom Perignon, going to the bars, and I started with Marcus & Millichap in in August. 60 days later, I sold this this South Dallas apartment complex for $6,000 a unit.
Okay.
We did inspections with shotguns. How rough it was. They thought I was crazy. That was my first listing.
Okay.
And I made $100,000 in 60 days.
Oh, wow.
In 60 days, I had no money, no nothing. And when I got the listing, my parents gave me an old Buick Skylark that actually caught on fire at the getting the listing from these at the lawyer's office. Getting the listing is great. The fire engines are there. I'm trying to get this listing, but I was so fortunate to sell it. In 60 days, I had this. Here I am, 22, 23 years old, had $100,000 in my pocket.
Yeah.
In 6 months, I spent it all up. I had a brand new car. I had fancy suits. Didn't pay the IRS, and I was, being a broker. It's like every January you're like broke again.
Yeah.
So that was my first really lesson. You can't do that. My young son, who just started at Marcus and Millichap, I said, save your money, pay your taxes.
Yeah.
You're broke every January.
Yeah.
So that was a real experience. So then I got maturity real quick.
Sure.
And then started doing more deals, and then lo and behold, a lot of my clients that were, they're big dog in it, Rolls Royces, fancy cars.
Sure.
87 comes, they changed the tax laws, and all these deals were not bought like they're bought today on economics.
Sure.
Real rent growth. They were all tax driven, and then I saw some of these guys that were driving Rolls Royces were driving Pintos.
Yeah.
And everybody was in bankruptcy, and I'm saying, oh my God. And my dad's telling me to come home, get in my business, we can and that's when I started representing, all these institutions that foreclosed on all this real estate. And I said, that was a real learning experience, guys coming in from California to pick up all this REO. And one guy I really learned from, he would go firm right away, close real fast. And he was buying a lot of lower demographic type deals, and he didn't have a lot of money to put back into them. And unless you're ready to put money into them, he failed. Like in the 90s, he lost a lot of his assets. So I learned from him.
So before we go into the RTC days, so back to kind of the boom time of the 80s that was Dallas. Who was buying this stuff? Was this like I was not in the business, obviously. I'm 42, so I was a little too young, but it was like doctors, high net worth people. Was this all a tax driven deal, right?
It was all syndicated deals. I mean, even Craig Hall was, Hall Real Estate was buying a lot of it, and there was a lot of promoters that were buying it and promoting the 3-to-1 or the 4-to-1, tax write-off.
So you put $1 in, you get $3 tax write-off?
3-to-1, 4-to-1, whatever it did. None of the deals made any sense whatsoever, and they weren't really operators. I mean, you look at you and I today, we're in the business because we're operators. We're going to own, manage, operate. We're not in here to get rich quick. We just want to come. This is our business. This is what we love to do. And I think a lot of the guys in the early 80s were all promoters. And a lot of them, are not in the real estate business anymore.
Sure. And then the RTC came in. So then a lot of these loans were made by savings and loans, S&Ls. Those all went bust. So they're making 110% loan to cost loans, and everything was just kind of a big house of cards. And I think I read a stat once that I think we have about 40,000 units roughly going on in Dallas-Fort Worth right now in some form of construction. And in 1985 or 6, I think we had like 50,000 units, and the population base is probably about double what it is today to what it was then, to tell you how much overbuilding was going on in the 80s. And that's why probably 25% of our apartment stock still today, even with all the construction we've had, is still based in the 80s here. And then the institutions came in, took all the stuff over. The Resolution Trust Corporation was formed by the government to kind of work this out. So you're still brokering apartment sales at this point. So you go from brokering it through these syndicators to representing these institutions and the RTC. What was that like at that time?
Really, it was really exciting times to be a broker and to learn and to underwrite these deals. And, you had the institutions on one side have to take these huge write-downs, And it took a lot of time and patience eventually, not kick the can, write it down, get them sold, and move the assets. And then it's kind of like how it was in 08, 2008, 2000. It took a while.
Yeah.
But it was exciting times to be a broker because, prior to, in 87, the market kind of stopped like it did in 2008. No one knew what to do. And then people started flooding our markets, buying our assets. And then I finally woke up and said, well, we better get a piece of the rock. And in 88, kind of started off, buying my first duplex, learned on that, and then slowly bought a 12 unit and a 56. And actually the 56 is right down the street from your deal. It was called the Wilshire House at Mockingbird and Skillman.
Yeah.
So when you got that deal at the Mockingbird deal, I go, God, I'd love to have another deal in Mockingbird. There for a while when I did eventually sell it, I thought I would never, ever sell that asset.
Yeah, it's a great location.
It was a great time. So, I started actually down in that Mockingbird area and started out with a duplex, and then slowly built up a portfolio to, 300 units. And it got to the time where you really can't do brokerage and own. I think you got to make a decision. And really what prompted my decision is one of my syndicator clients out of California felt like I was competing to buy, and he gave a listing to someone else in Marcus and Millichap.
Right.
And I said, that's it, I quit.
Yeah.
And I just had bought a 73-unit complex on the HUD courthouse steps on Spring Valley Road called Huntington Townhomes.
Oh yeah, let's tore those down.
And they're tearing those down now. Yeah. And the way that guy fixed the chiller system, he would just cut the pipes underneath the ground.
Okay.
Or the sewer systems, he wouldn't fix anything. So I moved my offices in there in the summer, left Marcus and Millichap, had this rehab from hell.
Yeah.
I had every credit card hooked up to China or wherever China's located.
Yeah.
And my parents were in that deal with me. They quit taking my phone calls. So we didn't have a plan. If we wanted new windows, we put new windows.
Yeah.
We wanted a new pool, we put a new pool in. Yeah. We wanted to make the facade look better and more presentable. We just did it.
Yeah.
And we had no plan. We just... And it was a chiller system. We converted it to individual HVACs. And that was my home.
And what year did you buy?
So I
Huntington?
probably bought that in 92, 93.
That's when you left. So you left.
I left
you were a broker about a decade.
Yeah.
Yeah, that's nice. So from 93 to today, that's really kind of really was when these deals first started kind of trading back, getting out of the RTC, because those deals really, the RTC kind of wrapped up around 91, 92.
Yeah, approximately. And there was still a lot of foreclosure deals being sold in the early 90s as well. And
do you remember what you paid for the Huntington townhomes?
I paid $3,000 a door at the courthouse step. I must have put in, I know I put about $15,000 a door in renovations. And then eventually sold it for over 40,000. And today, as you mentioned, they're now scraping it and going to build, wrap product on that site.
I own an asset 2 doors down from it. We own Lakefront Villas 2 doors down for it, and that's a great location. It just always as well.
Yeah, I own Hunters Point across the street.
There it is. Mike and I run across each other all the time. Geez, so you're in that deal for less than $20,000 a unit when it's post renovated. Do you remember what your rents were? I'm just curious.
I have no idea.
Yeah, $200-$300
I would
rents.
be guessing, and they were all big townhome units.
Yeah. That's amazing. So anyway, so kind of evolving. So that we went through, kind of got out of the RTC. Now we're in the 90s, kind of that mid 90s to about 2007. It seemed like that was kind of Texas was growing quite a bit, a lot of kind of migration, but the marketplace kind of was perceived as this is where you come to get yield. A lot of people from California were coming from California, had some 1031 money, come to Texas. That was who you were competing against largely, whereas California 1031 buyers. Maybe talk about that kind of period. How was that to kind of buy and operate, and what were kind of generally cap rates, and what did loans look like? Maybe talk about that 10 or 15 year period.
Yeah, so I remember when I first got my first loan, I remember calling John Brownlee at JLL saying, John, get me below 10%. I just want to be below 10%. And, cash on cash in those days, we weren't looking to get over a 5, 6 today.
Yeah.
Those deals, you were trying to generate 9, 10, 11, 12 and higher. And then I think that's causes me issues today when we're looking at deals, trying to out of the gate get a 5-6% out of the gate. And I remember the old days when we were, you wouldn't touch anything unless it was north of an 8.
But you had 10% debt then, and then so your cap rates and everything was amortized. There was no interest.
There
only.
was no interest only.
And you were
had
probably
higher
on
cap
25-year amortizations, maybe even 25, and so your cap rates had to be what, mid-teens to make these things make any sort of sense.
Well, I mean, they were 9, 10, 11% cap rates back then, and then you would, you'd still be able to leverage 75, 80% versus today where you're only leveraging 60, 65%.
Yeah. So that really kind of lasted up until about 2007, 2008. I know we had you on a panel a few years ago at a conference I was at, and we had Brian O'Boyle Sr. Interview you, and he told me the story about you bought a deal. Was it on Preston Road or on Montford over in North Dallas?
Preston Spring Valley, which we still own today. We bought it from him in 2002.
And so talk about that, because I know I heard the story. So maybe you kind of tell the story of that deal, because you bought that in 2002. Do you remember approximately what you paid for it in 2002?
I know like the back of my hand. So we bought it in 2002. It's a property I drive by every day. My office is right down the street. And my maintenance guys, my managers hate it because to this day, I still drive in there every day and make sure it's immaculate, because my in-laws live on the other side of the street. And so, they'd always give me a hard time, make sure that property looks good, because, we're by it all the time.
Yeah.
So, I bought it from Brian in 2002, and it was during a period of time when interest rates were again going back up. And I remember working out the Signature Club right up the street, and I'm watching CNBC, and we're supposed to rate lock our loan, and the 10-year Treasury's going up, and I'm sweating on that treadmill. I go, oh my God, this is really going to kill my yields. But the bottom line is, and that's why we're operators, that location will always be gold.
Yeah.
Preston Spring Valley is in the middle of the fairway.
Yeah.
And when Brian called me, at the time I had a little convertible. He says, you better put the top down. You're going to get really excited about this deal. Well, a few years later, I called Brian, that top is staying shut. And then, we get past 2008. Because during that period, anybody that could breathe would qualify for a single family home. Our rents dropped, our occupancy dropped. And
so if you're just driving around town, you would see all these 80s deals, because that was probably a 70s vintage deal, right?
No, it was late 70s, early 80s. It was built by Lincoln.
And you paid what, probably $30,000 a door or less for that, $40,000 a door for that. And this is, prime North Dallas real estate right now. And it's probably worth, 120, 130 a door, or maybe even more today. But at the time you bought it in 2002, and then all of a sudden everyone just started buying homes, and every time you drove around, it was one to 2 months free rent and flat to negative rent growth. And so it was a pretty challenging time to actually be an owner operator from 2002 to about 2007, right? Maybe talk through that a little bit.
Yeah, it was very difficult, and my rents dropped, the demographics changed, and here I got this 600 unit gorilla. It was a difficult time. And then also in 2008, had some debt coming due. There was no financing. And the whole key that we got through it all was the fact that our properties were well maintained. We had plenty of reserves, and I had to talk to Freddie Mac on that property and said, look, this is where the rents were when we bought it. This is where it is now. I got him to go interest only for a year. I told him I would put the amortization part back into escrow with them, because I'd owned that property for 6 years. So it was time to, repaint it, and we put the money back into the deal. And, fast forward today, it's, property stays 95+% occupied.
Yep. Tore down Valley View Mall next to it, and redeveloping into some multi-billion-dollar massive mixed-use development right down the street from you.
And we own the property behind it, so we basically control over 30+ acres right there at Preston Spring Valley. So
unbelievable. So then you got through that. So maybe some of the lessons you learned. I mean, that was a pretty good story where you had to go communicate with your lender. You had a problem, and your lenders, you're always your largest partner in this deal is kind of the way I view it. So you went to them, were forthright, upfront with them, talked through your struggles, kind of showed them the math, and then they were able to be accommodating, work through it, kick the can a couple of years, and all of a sudden we started kind of getting out of this because the market started growing again and people started doing transactions. What's been the last 10 years of this thing? Really, it's kind of, now we're in 2021, about 2011 forward, really is when the market started coming back out, because 2010, to in my estimation, or my recollection, was the bottom of the bottom for operators. It took a while for everything kind of get to the bottom, and that was a pretty rough year across the board. And then 2011 forward, we've been just kind of in the golden age of apartment ownership. I don't know if it could ever be as good as it's been this last 10 years. What was it like to own and operate, and how has the market shifted from your competition to kind of what's here today versus what it was at that time?
Well, the competition today is unbelievable. Being a buyer, it's like, I remember my days as a broker. In markets in Wilshire, they always wanted to, they were always the first ones to get listings. Now the brokers are really the kings because everybody has capital and everybody has capital to deploy. So it's, I always joke with the brokers saying being a buyer is like being a piece of grass. It's just whoever's going to pay the most or has, the cheapest quality capital to put out. That's our biggest competition. So it's been tough. I mean, we got up to over 7,000 plus units. We sold 2 deals in 19 last year. We were unfortunate to redeploy that capital. This year we haven't bought anything, partially because maybe we were a little bit conservative, really concerned about how COVID would affect us, what rent collections would have, how rent collections would be, et cetera. And we didn't push the envelope this year. Now, hopefully in 21, no one really knows what's going to happen with stimulus, what's going to happen with rent collections, what's going to happen with this new administration. But, so far, multifamily's been resilient.
Yeah. So what's driving right now, and as we're entering 2021, what's your guys' kind of plans? What are you excited about going in 2021? Are you still bullish on Texas and the major metros here? And what do you guys envision your business being, 2021 kind of going forward?
Well, I mean, we hope to grow in 2021. I mean, there is a lot of people moving to Texas that want to be in Texas. And hell, you saw Elon Musk, dancing in the streets in Austin, and you're going to have a lot more California people, and there's going to be great employment growth here in Texas and in both coasts. As a matter of fact, it's with the equity residential people, and they're thinking about coming to Texas, start buying. So I think from one perspective, there's still going to be a lot of competition for you and I to continue to grow, but hopefully we will. We've been living and breathing Texas for a long time. I think we're both well connected, and we both got the capital to move quickly on these deals. We got the teams in place. So our plan is to grow in 21. The one market that I'd like to see a turnaround, which we've been personally struggling in, is Houston. What happens with Houston? Here recently they've been having a lot of big corporate relocations.
Hewlett-Packard just moved there.
Hewlett-Packard.
It's a good feather in the cap.
So they need a lot more of that, and they need oil prices to firm up and medical to. So our plan is to compete and hopefully be able to grow.
Right now, what are you most concerned about from kind of a macro? Is there anything that kind of, if you lose a little bit of sleep, what would that be?
Well, as I mentioned earlier, we've been very resilient. We've collected 90% of our income. But here's the other side of the story. We collect about $5.2 million a month in revenues. That 4% represents over $200,000 a month. So basically, this 1 year period, we're going to be out $2.4 million. How much of that were we going to collect? What happens to these residents that haven't paid 30, 60, 90 days? We're not a credit card company. We're not charging interest. What does Congress do? What happened? we being in Texas, we're kind of been in a bubble. So these questions, we talk about it all the time because I don't have the answer.
Yep.
But but the bottom line is like we mentioned earlier, some of the stories, you just got to, you buy quality real estate, you have adequate reserves, and you manage, and you don't distribute all your funds to your LPs. You make sure that there's gonna be a rainy day. I mean, I've been through a lot of rainy days, and you got to make sure that you got an umbrella.
What we talked to a lot of your investors. You have numerous. You know how many K1s you're going to do this year? How many investors do you have kind of in the roster right now?
Yeah, it's we have 300, 400 investors have been with me from the get-go.
What do you probably talk to some of them on a regular basis, just kind of just through your ordinary course of business? What are these people fearful of, or what is your investor base worried about that you don't think that they should be worried about? Is there some sort of misconception of risk within the marketplace that you think's maybe a little bit misplaced or misfounded?
Well, I think they've been with me for a long time. They do worry about some of because it's kind of interesting. That's a great question, because one of them, he said, well, you're paid $40,000 a door for a 1980 deal back in 2002, and that same asset you're going to have to pay, 130, 140,000 a door.
Yeah.
And interest rates are really low. What happens in 10 years if we're back to where they were in the 80s and interest rates are, and my answer is, quite simple. We're buying quality real estate in great locations. We'll maintain these assets. And if that time comes, and we'll deal with it.
Yeah. Yeah. So kind of the fear of the unknown. It seems like you go back in time, you look at the kind of the actual interest rate chart and kind of what at the time, what the future expectations were. The rates have always kind of, or the last 20 years or 30 years or so, rates have been kind of steadily going down. And everyone at all times thought interest rates were going to go higher than they actually really were. And we're here in an environment, I don't even know how many trillions of dollars of national debt we have, approaching $30 trillion of national debt, and in 2020 we increased it by over $3 or $4 trillion. I mean, it's just been staggering, and how the hell are they going to actually raise rates? So it seems like everyone is in the mindset that rates are going to be low for a very long period of time. So maybe that kind of has me a little scared, because everyone's expecting one thing. Finally, we've been all thinking rates are going to go up, and they've done nothing but down. And now we're here at the bottom. We all think they're just going to stay low. So maybe they do go up. But I think, to your point, if you buy right, you manage it right, you set your deal up with adequate reserves, and don't distribute all your cash flow, and make sure if you own a building for 10 years, you're going to have to paint it. And you're going to have carpentry work, and your parking lot's going to wear out. And, if you own older assets, like you have several 80s deals left, those, the pipes aren't getting any younger, and you got to address some of the fundamental structural deals with these these properties, with the wiring and the sewers and the parking lots and the balconies and all those things just kind of wear out over time. If you have a son that just got into the business here recently, working at Marcus & Millichap, he's fresh out of college. What advice would you give to somebody that's looking to kind of break into our industry? It's been a great industry for both of us. We've both monetarily, professionally, and personally, it's very rewarding doing what I do for a living. What advice would you give someone that's trying to come out of college to break into our industry, to kind of be sitting on the same level on these chairs that we are here today?
I think it's real important. What I learned at my time at Marcus & Millichap, or your time starting out in the lending business, they're really the same. It's learn and see what works, see what other people are doing. I learned from a guy that came in here and bought a lot of units, and how he operated, how he bought, how he managed, and I learned from him what to do, what not to do, and have a mentor. And not only is my son there, my nephew's at Marcus & Millichap as well, and they're working around great people, and they're learning. And not everybody can be an operator, not everybody can be a broker. I love my assets. I mean, it sounds kind of crazy, but I love my buildings, and I tell you can't do both. I don't think you can be out brokering and buying and operating. Find what your passion is for it, learn, and go for it.
Yeah, that's good advice. I think we all have had mentors that we didn't get here on our own. We kind of got on the backs of other people have helped us kind of get to where we are, observing a lot of our clients that did better and some of the clients that didn't do quite as well, and trying to learn from the mistakes of other people, so you don't have to pay the price that they had to pay the price. So definitely good advice. I know, kind of looking forward in 2021, I know we kind of, before we started recording, you started talking about what you're excited about. What are you excited about 2021? I know you have a new fund that you're going to try to launch here. Maybe talk a little bit about that as we kind of wrap up this conversation.
So everybody's looking for yield today. And we've been doing onesie, twosie, threesies, so I thought maybe be a little bit more competitive with all the capital coming into this marketplace, is already have a fund ready to go and take advantage if there's some opportunities. I don't think we're going to see any big disruption or anything per se. I mean, there might be some people that haven't taken care of their assets, or they do have debt, or their loans starting to amortize, or Houston, there's starting to be some issues down there and some delinquencies. So our plan is to go to our existing investors and with the point, look, let's get this fund kicked off. Let's have 4 or 5 deals in this one fund, and we'll do fund 2, but be ready to take advantage, or be ready if we find something that we can jump on. If you get in those best and final calls and they say, well, where's your capital? Or our capital's sitting in the bank.
Yep.
So, we got a lot of investors. They've been quite upset with me this year because we haven't bought anything.
Yep.
And then in the same token, we got 2 deals that we're refinancing in the first quarter, and we're going to have all this cash. So
it's a real problem. I mean, you think it's a good problem to have, but that's a real problem to have. You give this money back to these people, and they're like, I don't want to back you. I'm going to give it back to you. I want to do the next deal and the next deal. It's actually a real problem. And it's pressure that you have to try to stay disciplined to not just go do deals because the capital is available. And that's kind of what gets a lot of these folks in trouble. If people want to find out more information about you, Mike, what's the best maybe resource to learn a little bit more about you or Price Realty?
Yeah, so go to pricerealtycorp.com. My phone number's on there. Feel free to contact me anytime. I'm kind of tell people I'm 24/7, and that's the best place to get a hold of me. And I'm more, and anybody who's just starting out and have questions, I'll be more than happy to take the time to discuss their business plan or any way I can help, because I want to give back what was given to me. So.
Well, it's very generous of you, Mike. So Mike's been around a long time. Definitely appreciate him spending a few moments with us here on our podcast today, and definitely appreciate you coming in. Michael Becker from Mike Ochstein. Appreciate it. We'll see you guys next week.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.